Hello and welcome to Nolan Financial Radio. My name is Chris McKinney from Nolan Financial Partners. If you'd like more information about your here during our show today, give us a call at 719-210-4242 or visit us online at our website, nolanfinancialpartners.com. And while at our website, click on the radio page, check out our past shows, subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. Wherever you listen to your podcast, actually, we're probably there. You know, there's one number that a lot of retirees watch very closely every fall, and it's not their fantasy football scores. It's the Social Security cost of living, or COLA. The Social Security Administration recently announced the 2026 COLA. It's a modest increase, but it means a lot more breathing room for millions of retirees. So I was reading an article from Kiplinger, 2026 Social Security COLA, and it notes that this increase is going to be, it's good, but it's not great. It's not a dramatic jump, but in today's environment, even small adjustments can help offset the rising prices, right? So interestingly, this announcement was delayed a bit because of the recent government shutdown. Now that we're not in the shutdown, things are happening all over the place. Some Bureau of Labor Statistics employees were brought back actually during the shutdown to finalize the Consumer Price Report Index so that they could calculate the COLA. And then now they're finally letting that news out just a little later than usual. Retirees can now plan around that new number for the next year. So before we get started, let me bring in my co-host, Tony Shore, who swears his coffee budget could use its own cost of living adjustment. Tony Shore.
Well, yeah, I love my coffee, but I don't always go for the expensive stuff. But today, and we're recording this, I did go for the expensive tall iced shaken espresso. I needed it this morning, Chris. But you know what could really use a cost of living adjustment is my vinyl budget for records.
Oh yeah, you ain't kidding there.
They've gotten really expensive, and you know me, I love to buy new music, and I love to listen to it on vinyl. So that's my weakness right there. Everybody has one, I'm sure.
Right.
At least I tell myself that when to justify my own. So, Chris, this is a great topic, but before we get into it, how have you been? You're keeping busy, I assume.
Yeah, we've been staying busy. We've done some seminars here. We had a really good turnout for the seminars, and people are really interested in helping their retirement by getting some professional help, right? So there's some people are like, should I get professional help? When they come up and ask me, I'm like, well, yes, since I'm a professional, I would say get some professional help. But I've never had a meeting where I couldn't show something to somebody that they had not understood about their retirement years. So, there's just so much to it. No one person kind of knows it all unless you are a professional and you study it. And most people, they look kind of what they look at. They look at, if they have their own brokerage account, they just look at their stocks. If they have mutual funds, they just look at their mutual funds. They don't look at the whole gamut of retirement options out there, the different retirement plans that are out there, the different ways to create a retirement plan that can weather the storm of 50% drop in the market like we saw in 2021 through 2022. What happened to your funds back then? If you're retired, were you still pulling money out when the market was down 50%? That could be problematic. Anyway, I get excited about talking about finance.
Yes.
Today we're here to talk about Social Security. And so retirees often spend more in areas like healthcare, housing, and prescriptions. And so that's one of a couple of things I do pick up when I start bring up when I start talking to people. So COLA math says that the increase we got is pretty reasonable, but someone who's seeing their out-of-pocket medical cost jump might feel like they're falling behind. And you really can see how wide the swings have been. So if we go back to 2016, COLA was literally 0%.
And COLA is the cost of living adjustment that we're talking about to help keep up with inflation. But
Yeah,
yeah, it's literally been nothing
it
they've
was
been. There
nothing.
have been years where they haven't increased it at all. So the
Yes,
last one was 2016, right?
2016, and
Yeah.
prices of goods were actually going down in some areas, and so that brought the consumer price index down. Of consumer price index is what the COLA is are based on. So now, just a few years later, in 2023, we saw inflation spike after the COVID supply disruption. So we had smaller supplies, but then we had a lot of people with a lot of money to spend because they haven't been going out, they hadn't been going to stores, they haven't been doing anything, and so cost of living went way up to 8.7. There were competitions for some things like vehicles. Some vehicles were going out of this world. Trucks were going out of this world on pricing back then. So it was one of the biggest jumps in recent history, that 8.7 back in 2023.
Yeah.
Since then, it's cooled off, 3.2 in 2024, 2.5 in 2025. And now for 2026, the cost of living adjustment is 2.8. So it's kind of in line with the last couple of years. And so we're starting to return to that normal area where it's somewhere between 1 and 4, right?
Mhm.
Typically around 2, sometimes as high as 3, but that's very typical to have a cost of living somewhere in those ranges.
Yeah. Yeah, interesting. So, I think a lot of people still remember that 8.7 COLA increase or cost of
Oh
living
yeah.
adjustment to Social Security. That was a pretty good jump a couple of years ago, and I think that spoiled us and spoiled people because then they're like, okay, things are getting exponentially more expensive, but at least we're going to start seeing these higher cost of living adjustments. But what you're saying is actually a number closer to 2 or 3% is like
Three.
this year. It's pretty typical,
Yeah.
and it may be a sign that inflation is calming down, not heating up.
Right. And so it's hard to know because some things are going up, but other things have kind of stabilized. And so that's the consumer price index.
Yeah,
And so we use the consumer price index for urban wage earners and clerical workers. It's called the CPI-W. So it's for people that have kind of workaday jobs, not for people like me who, don't show up at an office and sit there all day.
sure.
It's off people that have that W-2 income, and so that's where they get their CPI-W.
Sure.
Um,
And they have their own calculation that, and the frustrating
yeah,
thing, I think, with this cost of living is it doesn't actually keep up with things like health. I mean, healthcare has gone up exponentially this year.
right.
And compared to what the COLA increase is for 2026, we've seen bigger increases in a lot of areas, not all. But I don't think they always count things like groceries or healthcare when they figure out that consumer price index, do they?
No, they don't. And another thing that they don't figure is property taxes.
Ah, and those, I don't know about yours, but mine in the last 3 years have tripled.
Right. And so the prices of homes have gone up about double in our area. And
Mhm.
so yeah, so even on bare land, mine went up 50%
Wow.
in 1 year. So
Wow.
it's like I don't understand why it would do that on an unimproved land, but that's what they did. And I don't remember voting for a county increase in taxes,
Mhm.
but it kind of happened. Somehow they are getting more. So, but I bring this property tax up because if you think about a homeowner, they're living on a fixed income in retirement. They're relying on Social Security for maybe 50% or maybe even more of their retirement income, and we have our property taxes on our home. Even if we paid off the mortgage, we still have to pay those property taxes every
Yeah.
year.
Yep.
And if they go up by 50% or 100% or 3 times, then how can this COLA be keeping up with that? They're not. It's not part of
No, that's not.
their
Property taxes and
index.
local and state taxes aren't part of their. If there's increases there, that's not calculated in. And I know they're not taking the actual healthcare
No.
increases that I've seen into account
No,
either with
they're
the
not.
consumer price index. So, that's interesting how they come up with that COLA, though, right? And it's not
It
even
is.
based on a whole year, is it? I think they look at specific, like
No,
3.
they pick July, August, and September. Now, why they pick 2 months when the kids are not in school to
Yeah,
look at inflation?
yeah,
Okay.
yeah.
But
Weird.
they only compare it to last year's July, August, and September. So I don't know why they would pick that time. It's also a time when there's some of the biggest sales because of
Yeah,
return to school sales.
interesting. So it really is a reflection of what's happening with inflation in those 3 months, not
Those 3
the
months,
entire year, right?
not the entire year. And, you know, it's just an odd time to me. I don't
Yeah,
know why
that
they
is weird.
wouldn't
Well,
pick.
we're not gonna solve why the government does the
No,
things it
that's true.
does today.
We could, but they wouldn't listen to us.
You're right. We could solve. I think we could come up with probably a better plan and a better algorithm or calculation for them to use. But would they do it? No.
No, they would not do
No.
it. So anyway, there's a direct reflection of what's happening in those 3 months
Yeah.
to what they come out with the cost of living adjustment based on the consumer price index.
Yep.
And so now there's some people that want to change the CPIW to the CPI-E, which is a different thing. I don't want to go into the CPI-E right now, but it's not set in stone how they're going to continue to do this. They
Right.
didn't have COLA. Didn't have COLA when they created Social Security. It just came up in the 70s. So
Yeah.
so COLA is not, written into the Constitution or
Right.
anything like that.
Right. But I think it is worth noting, and I know why you brought it up, because the CPIE, there's a push for this because that focuses on Americans age 62 and older, not just across the board. Because cost of living for those 62 and older is different. Then they would need to include more of the healthcare costs because they're spending more on those things. And if they actually looked at what retirees are spending their money on and base the increase, like property taxes, healthcare, things like that, I think it would be better off for retirees. But then the government doesn't want to make the switch because then they'd have to pay more COLA each year, probably.
Right.
So,
Well, and then the CPIW that goes into the COLA, the COLA that gets set from CPIW, it also goes toward federal employees, federal workers,
yeah,
federal retirees,
sure.
and military retirees and people in the military as well. So that same COLA that gets applied to Social Security gets applied to those right now.
Mm-hmm.
If they took it to the E, then they would have to separate those.
Yeah, that's true.
That wouldn't be right.
Yeah, and Social Security benefits aren't just for retirees, obviously, right?
Correct. Right. So we have there's disability, there's orphaned kids that get Social Security. There's all kinds of people that collect Social Security that aren't in retirement.
Yeah. So, and I know whenever we do a show on Social Security, I'm reminded all over again just how many layers this program has.
Oh boy.
And I know it's a popular topic because people need to try to figure this out. And I'm glad you're here to help us with this because,
right.
This is what you do. Social Security is the foundation of any solid retirement income plan. So what's something else that we need to know here about Social Security?
So there's important thing about Social Security that if you're still working, your earnings may temporarily reduce your monthly benefit. So there's an earnings test that goes against your Social Security if you're receiving it before your full retirement age. So if you're getting that, you want to make sure that you probably shouldn't be taking Social Security if you're still planning to work at all.
Right. Yeah.
Because anything over $24,480 for 2026 is going to cost you money out of your Social Security benefits that would come. So every $2 above that number, that 24,480, for every $2 you earn, $1 of your Social Security benefit will be withheld. So if you make $75,000, then all of it will be withheld. So don't work or don't start taking it is what you should do.
Yeah. So if you're going to work and make more than $24,000 a year, which most, if you're working full time,
Right.
hopefully you will, make more than that in full time work. But some people think, well, I'm going to take Social Security early at 62 because that's what my buddy did, or that's what I've heard is the best because you get more checks that way. And then they keep working. I had a neighbor that did this. Yep. He took it at 62. He worked full time and was making six figures. So he basically almost got nothing. His Social Security, they withheld everything. And he's like, why am I not getting checks? And or why are they tiny? Why am I not getting anything that I thought I would get?
Why'd you send me $10?
Well, plus, and will he get that back? Yeah, they might pay him back that over time eventually, but you're not going to get it while you're working, and you locked in a lower amount for no reason then, because you're not going to get it yet, and you're locked in a lower monthly amount. You could have waited and let it roll up. And really the difference is big, isn't it?
The difference can be big. It's about 8% a year once you reach your full retirement age. The numbers are a little flaky before that about how much it goes up each year, but there's a 30% reduction from age 67 if you take it from at 62. So if your Social Security was going to be $1,000 a month at 67, it'd be about $700 at age 62.
That's a pretty big monthly reduction. That's going to add up over the course of your entire retirement because you can't go back and change it. The only way it's going to grow is with this cost of living adjustment.
Yeah.
And have you said the exact, I may have missed it, the exact COLA adjustment for this year
so
for 2026?
Yeah. So if you missed it earlier, it was the exact adjustment is 2.8%. So for most Americans, that means about $56 a month for a single person.
Yeah.
So $56 a month, that's $672 a year. Mm-hmm. Now remember, not all that money is taxed. So depending on your tax situation, Social Security is taxed at different levels.
Yep.
So it could be 85% of your Social Security is taxed. Half your Social Security might be subject to tax,
or none.
Or none.
Yeah.
So those are the different levels. So there's reasons to make sure you know what those are, because some people can reach zero taxes in retirement, zero taxes on their Social Security while they're in retirement, and still bring in plenty of money for them to live, not have to live like a pauper. They can still have a lot of fun.
Right. It depends on how it's set up. And I know that's something you and Tara there at Nolan Financial help people with, is getting that tax-free income bucket set up and looking at future tax issues in retirement. That's really good to know. And for people staying active in the workforce that might think about start tapping into their benefit early, it sounds like you need to be working with a trusted professional to help you with timing and strategizing, and it could affect your spouse too with spousal benefits. And I think this is good. So what else should listeners know out there about Social Security changes in the new year?
So there's that taxable wage cap is another important Social Security update for 2026. So this will affect people who are still working. So this is how much you pay into the Social Security program while you're working.
Oh, okay.
That cap is increased to $184,500. So it's about an $8,400 increase from 2025. So that means that more of your income is subject to Social Security, but everything above 184,500 will not be subject to the Social Security payroll tax, right?
Yeah. So if
So,
you're still
so
working, that's the money that's taken out of your check each pay
that's right.
period to go into the Social Security system. And I know a lot of people have floated the idea that they could fix Social Security, which they say the well is running dry. They could fix it. One way they can fix it is to eliminate that cap altogether. So, you got
Right.
some you might have a bunch of CEOs or higher paid people or business owners that their take home pay a year is 500,000. Well, they're only paying into the Social Security system up to
As if
184,000.
they made 184,000. So they're
Yeah,
basically getting a tax break
yeah,
that
and
nobody else, that people underneath them don't get.
yeah. So I think that'd be fair. But then
Underneath them
people,
and pay.
yeah, but then people say, well, then we'd have to increase their benefit too, right? And I said, nope, you can put a cap on. You're willing to put a
No.
cap on Social Security payroll taxes, that you should be willing to put a cap on payout, right?
Right.
For that. And that's my opinion, and I know there's different debates going on, but I think a lot more and more people. I mean, even the wealth. I think Warren Buffett came out and said, why isn't all my income,
So
why don't I pay Social Security tax to help the system out from my income?
yeah,
It's the only
yeah,
way it's gonna, different people, including very wealthy people, have said the only way we can fix it is if we pay more in. And so, and
right.
then there, I
And
think I think it's fair, but again, I'm not a
and
billionaire, so it's easy for me to say.
well, and it wouldn't be a lot of money. The Social Security
No, it's
payroll tax is very low, and
yeah,
most of those the people we're talking about, they don't have large payroll income, so it
no.
doesn't affect them that as
It's
much
not
as
like
you
their
might
net
think.
worth. Like, people aren't gonna be,
No,
if it was their net worth that we could tax it, we could probably just tax a couple of them and
yeah,
pay for everybody's Social Security. But yeah, no, it's only what they actually show they make. And some people don't, some of those people might show they made $50,000 last year, $100,000.
right.
That's how they operate. But it's all in capital or other places, or reinvested, so it doesn't show up as income. But at any rate, I don't want to get us off topic. So people who are earn above that limit, their take-home pay might see a small bump once they hit that cap, but it doesn't really translate to higher Social
No,
Security benefits down the road. It's not like if you pay more in, you're going to get more benefits anyway, really, right?
that's right. And so let's talk about that for a minute. So when you talking about what you're going to get in Social Security, it's your 35 highest payroll years.
Right.
So you can go look at that list and go out to ssa.gov and sign up, and then you can look at what your income is on their ledgers. They also still send the letter out, I think. But anyway, you can get it there if you can't find that. So for people that maybe own their own business and set their own salaries, maybe you're not putting into Social Security very much because you're limiting your salary. Well, think about that for a minute. Talk to your CPA. It would be better for me to add, have that $50,000 a year income so I can have 35 full good years of that so I can get a better Social Security output. Or is it better to, do the machinations so that we don't put as much money in the salary? So it's something to think about for people on Social Security is my best 35 years. When I was 20, I didn't make a lot of money. I make a lot more money now. So, so these years are going to push off those lower years, And so I'll get more Social Security because I've worked longer. It's another reason to wait for your Social Security to start, because you get those added years into the calculation. Once you start Social Security, then those years don't get added to your last 35. And so when do we make the most money? Well, when we're older, usually,
Yeah.
right?
Yeah.
So we make the most money toward the end of our careers. So that by waiting to take Social Security and getting those higher wages on your ledger with the Social Security Administration, you're going to get more Social Security.
Yeah.
The other thing you need to know is you need to have 40 credits over your working lifetime to get Social Security.
Yeah.
You can earn up to 4 credits a year. You don't have to make a ton of money, but you have to make enough in every quarter to get the 4 credits.
Yeah.
And so it's basically 10 years of working and making a decent salary. Right?
Most people will work 10 years out of their life at least and qualify. Most people end up qualifying for so yeah. So and there are obviously exceptions. But before we go, we're running out of time. But before we go, I wanted to bring up the importance of when you file, and spousal strategies if you're married is huge. So if we have listeners or viewers who have not yet filed for Social Security or just recently filed,
right?
Because when you're within 12 months, there is a way to still go back and change it. Otherwise, you're locking it in for life. Yep. So you need to make the right decision. You have a report you can run for people, and you help people figure out how to maximize their Social Security. Yep. So before we go, we're talking about that 2.8% increase in your benefits for 2026, but you also need to make sure you've maximized your Social Security. How can our listeners out there and viewers do this?
So if listeners want to get that report on how to maximize their Social Security, they need to give us a call at 719-210-4242. Make an appointment. There is no charge for the appointment. It's complimentary. Make the appointment. Give us a call, 719-210-4242. Check us out at our website. You can listen to this radio program and our past radio programs, so you can kind of get to know us a little bit. Out there on the website, it's nolanfinancialpartners.com. But for right now, give us a call, 719-210-4242 to set up that complimentary consultation.
All right. Sounds great, Chris. And listeners, that does it for today's episode of Nolan Financial Radio with our host, Chris McKinney.
Join us next time for another great episode of Nolan Financial Radio.